Hello and welcome back to Beyond the Charts. This series is where we look at charts to make sense of what's happening in finance and economy and uncover the stories they tell. For all the charts and sources from this video, do check out our newsletter. The link is given in the description below. Now, remember when the interest rates were close to zero? Back then, governments could borrow cheaply. They racked up record amounts of debt to pay for everything from pandemic relief to new infrastructure. But that era is now over, and the bill is coming due. A Goldman Sachs report shows how serious this has become. Even though central banks have started cutting down interest rates from their highs, the interest burden on major economies is still rising. Now, here's what's happening. Old, cheap debt is coming due and being refinanced at much higher rates. It's like a homeowner whose 2% mortgage expires and suddenly has to refinance at 6%. The debt itself hasn't grown, but the payments have shot up. For now, governments are still cushioned by the ultra-low rates of the past decade, which keep interest costs at a lower end of historical ranges. But that cushion is fading as older bonds mature and are refinanced at higher rates. Since the pandemic, budget deficits in the US, UK, and Europe have regularly ended up larger than initial projections. Now, this isn't just a bookkeeping problem. Rising interest costs are mandatory, which means that governments have no choice but to pay them. That leaves less room in the budget for areas like healthcare, education, infrastructure, and climate programs. The Goldman Sachs report points out that spending on social protection and healthcare is already near the top of historical ranges, which makes cutting back politically difficult. At the same time, defense budgets are also climbing across much of Europe. Now, to bring budgets under control, governments face a tough choice. They either raise taxes or cut down public services. But higher taxes aren't a simple fix either. In much of Europe today, revenues have already above their historical average as a share of GDP. And Goldman Sachs notes that higher tax to GDP ratios often go hand in hand with slow growth. Another big question here is whether real interest rates are actually rising faster than real growth. Because if the cost of borrowing ends up higher than the growth rate, managing debt becomes much harder. Long-term bond yields have already climbed, reflecting these fiscal pressures. In fact, 30-year bonds in the US, UK, and Europe are now at their highest levels in decades. Now let's move on to China. See, China dominates the global solar industry, controlling close to 90% of the world's manufacturing capacity for solar cells. This has helped drive solar panel prices to record lows, speeding up the global energy transition as well. But a recent Financial Times article shows that the industry is now facing a severe crisis. In the first half of 2025 alone, 6 of China's biggest solar companies lost a combined renminbi 20 billion or about 2.8 billion US dollars, which is more than double of their losses from the last year. Driven by Beijing's push for technological leadership, Chinese companies rapidly expanded capacity, adding new factories and production line at an unprecedented pace. In 2024 alone, China produced about 588 gigawatts of solar cells, which was far more than the combined demand at home, standing at about 277 gigawatts, and abroad, which stands at about 174 gigawatts. The result is what economists call involution, which refers to intense internal competition where everyone produces more, but no one actually gains. To clear excess inventory, Chinese companies are now selling solar panels at prices below the cost, hoping to outlast their rivals. Since 2021, solar module prices have nearly halved. For consumers worldwide, that means record low installation costs. But on the other hand, it's been devastating for producers, as margins have disappeared and balance sheets are under heavy strain. What was once one of most China's profitable green tech sectors is now loss-making. The upside for the rest of the world here is cheaper solar, which helps speed up the green transition. And the downside is that this wave of cheap state-supported exports is hurting solar manufacturers in the US, Europe, and India, which could spark trade disputes. Now, by 2030, the global semiconductor market is projected to cross about 1 trillion US dollars, up from about $600 billion today. A new PwC report says that this surge is being driven into two forces: the rise of artificial intelligence and the transformation of cars into software-driven machines. See, semiconductors are no longer just about powering PCs and smartphones. Those remain huge markets, but the fastest growth is coming from new areas that needs more specialized and powerful chips. Services like ChatGPT have kicked off arms race for computing power. PwC projects that chips for servers and networks, which is the backbone of data centers and AI training, will grow the fastest, expanding at about 11.6% a year by 2030. By then, data center chips will alone account for more than half of the industry's revenue. The second big growth driver is autos. With electric vehicles, autonomous driving, and software defined cars, vehicles now use more chips than ever before. Now, to put that in perspective, a basic level 0 or a level 1 car, meaning no or minimal self driving features, has less than a $500 worth of semiconductors. But whereas a fully autonomous level 5 car, which is capable of driving by itself in all conditions, could pack in more than a $5,000 worth. That tenfold increase comes from the need of high performance computing, advanced sensors like cameras, radar, and LiDAR, and always on connectivity. Automotive chips are projected to grow at about 10.7% a year, making it the second fastest growing segment after servers. But remember, this isn't just about technology, it's also about geopolitics. The race for semiconductor leadership is reshaping global supply chains and national policies. See, chips have become central to the contest for technological supremacy. Worried about supply disruptions, governments are now pouring hundreds of billions into local manufacturing and research. The US CHIPS Act is aimed at bringing advanced chip manufacturing back home. China, meanwhile, is doubling down on older, so-called mature node chips, which are older generation chips and are still widely used in cars, appliances, and consumer electronics. They remain a big market, and one where China can keep growing despite US export controls. At the same time, Taiwan's TSMC, South Korea's Samsung and SK Hynix, and Japan through projects like Rapidus and its joint venture with TSMC and Sony are all scaling up. The result is supply chains that are more diversified but also more politicized. Another big change is the shift from general purpose chips to application specific ones. These are custom designed chips known as the ASICs, which are built for particular tasks. For example, some are designed only for AI training, while others are built just for car sensors. Big tech companies like Google and Tesla are already designing their own, both to boost performance and to reduce dependence on outside suppliers. Automakers are following the same path, creating chips tailored for electric vehicles and self-driving systems. In earlier editions, we've focused on India's mutual fund industry. So this time, let's look at some fascinating charts from a Franklin Templeton report on the US and global mutual fund landscape. See, when we discuss mutual funds worldwide, it's essentially a US story. The scale of the American market is staggering and makes the rest of the world look small in comparison. Globally, regulated open-end funds held about 74.5 trillion US dollars in assets in the first quarter of 2025. And the Americas, driven overwhelmingly by the US, account for the bulk of it. The Americas account for about 57% of the global mutual fund assets. Europe is far behind at 32%, and the entire Africa and Asia Pacific region combined makes up to just 11%. In the US, mutual funds are central to how people save and invest. The report notes that 56% of the American households hold mutual funds. Now that's about 127 million investors. It's a level of participation that most of the other countries, including India, can only aspire to. The scale is just as clear when you look at assets under management. US investors allocate heavily to equities. Together, US equity funds at about 48% and the world equity funds at about 13%, which make up to about 61% of the total. In contrast, bond funds at about 18% and money market funds at about 17%, which account for most of the smaller shares. Now by 2025, that picture has flipped. Passive funds now hold about a majority 51%, while active funds have slipped down to 49%. The big drivers have been lower costs, easier access through ETFs, and the fact that most active funds have struggled to even consistently beat the market. It's one of the most significant shifts in modern finance. That's it for this edition. Thank you for watching. Do let us know your feedback in the comments below.